Have you ever wondered how investors decide where to put their money? Well, it's not just about gut feelings or following trends. Instead, they use a set of powerful tools known as investment appraisal techniques. These techniques are like a compass in the vast ocean of financial markets. They guide investors in identifying the most profitable ventures, all while keeping an eye on potential risks. Whether it's a new startup seeking seed money or a well-established company looking for expansion, these techniques help investors scrutinize every aspect of potential investments. They assess the projected returns, weigh the risks, and evaluate the time value of money. From the net present value to the internal rate of return, from the payback period to the profitability index, each technique provides a unique perspective on potential investments. In the next few minutes, we'll uncover the secrets of these techniques and how they can help you make better investment decisions. First up, let's dive into the net present value, or NPV. This financial metric is a fundamental part of investment appraisal and helps investors understand the potential profitability of their investments. But how does it work? Well, NPV is all about the concept of the time value of money. It's the idea that $1 today is worth more than $1 in the future. Why? Because you can invest that money and earn a return. So when you're considering an investment, you need to look at the cash flows it's expected to generate in the future and discount them back to today's dollars. But here's the crux. The NPV should be more than zero. In other words, the discounted future cash flows should exceed the initial investment. This indicates that the investment will generate more returns than the required rate of return. So in essence, NPV helps you understand if your investment will be a profitable one in the long run. Next on our list is the internal rate of return, better known as IRR. This clever tool is the interest rate at which the net present value, or NPV, equals zero. Think of it as a break-even point for your investment. But what does this mean for you, the investor? Well, IRR helps you compare different investment options on an equal footing. It gives you a percentage that represents the annual return you can expect from your investment. You can then use this percentage to compare different investment options. For instance, if one investment has an IRR of 15% and another has an IRR of 10%, it's clear which one promises a higher return. But remember, a higher IRR doesn't necessarily mean a better investment. It's crucial to consider other factors such as the risk involved and your own financial goals. Thus, IRR can be your compass in the world of investments, pointing you towards the most lucrative opportunities. Now let's talk about a simpler yet powerful tool, the payback period. The payback period is as straightforward as its name suggests. It's all about figuring out how long it will take for an investment to pay back its initial outlay. Think of it as a stopwatch, ticking away until your investment crosses the break-even point. Imagine you're planting a seed. You water it, nurture it, and wait for it to grow. The moment it bears fruit, that's your payback. With investments, the seed is your initial capital. The nurturing is the time and effort you invest, and the fruit is your return. The payback period is the time it takes for you to start tasting that fruit. But why is it important? Well, it helps you assess the risk associated with an investment. The longer it takes for an investment to pay back, the riskier it is, as it's more exposed to market fluctuations and uncertainties. Remember, the shorter the payback period, the less risky the investment. Last but not least, let's explore the Profitability Index, or PI. The Profitability Index is a powerful tool in the world of investments, and it's calculated as the ratio of the present value of future cash flows to the initial investment. What does this mean? Well, it essentially tells us whether an investment is likely to generate more money than it costs. Now imagine you're an investor with several potential investment opportunities. The Profitability Index can help you rank these opportunities based on their potential for returns. The higher the PI, the more bang for your buck you can expect. A PI of more than 1 signals a potentially profitable investment, while a PI less than 1 suggests you might want to reconsider. It's clear that the Profitability Index is a handy tool, allowing investors to make informed decisions and potentially maximize their returns. So, PI can help you prioritize your investments based on their potential returns. Now that we've unraveled the mysteries of these investment appraisal techniques, what's the takeaway? Each technique we've discussed today is a powerful tool, designed to reveal different aspects of an investment's potential profitability and risk. Net present value, or NPV, allows us to look into the future and bring all those potential profits back to today's monetary value. It tells us whether an investment could be more profitable than simply putting our money in a bank. It's a great technique for those who want to compare the value of future earnings to the value of money today. The internal rate of return, or IRR, is a percentage that shows us the annual growth we can expect from an investment. It's like a compass pointing to the investments that could grow our money the fastest. The payback period method is like a stopwatch. It tells us how long it will take for an investment to pay back its initial cost. For those who need their money back in a specific time frame, this technique is invaluable. And lastly, the profitability index, or PI, is a ratio that shows us how much bang we're getting for our buck. It's a technique that's perfect for comparing different investments to find the most profitable option. In summary, these techniques are not magic wands that can predict the future. They are tools that can help us understand the potential of different investments. By using them, we can make more informed decisions based on concrete numbers and logical reasoning rather than gut feelings or hunches. Remember, the key to successful investing is not just about picking the right investments, but also understanding how to evaluate them. Now, you are equipped with the knowledge to do just that.